Now, on this InvestTalk podcast, Justin Klein listens to your questions and provides unbiased answers.
The chart is definitely in a downtrend, and it's definitely not cheap enough yet.
InvestTalk. Your participation makes it unique. 888-99-CHART.
This is InvestTalk. Independent thinking, shared success. Justin Klein and Steve Peasley stand ready to take your finance and investment questions and share their unbiased answers. InvestTalk is made possible by KPP Financial, a registered investment advisor firm serving clients throughout the United States. The clarity for your path forward starts now. Here is KPP Chief Executive Officer, Financial Advisor, Justin Klein.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Thursday, July 28th, 2022 edition. I hope you all are enjoying your summer. Between the volatility and the heat, I know things can get a bit uncomfortable. Dallas, Texas hit 102 today, and I know we have InvestTalk listeners there and around the world. Medford, Oregon reached 111. Wow. Still gets hot up there in Oregon. And the big question, though, for you is, how are you handling the heat in the market and the volatility? And remember, volatility goes both ways. It goes down and it goes up. And in normal markets, you tend to have kind of steady increases and swift drops. And in bear markets, what you have are steady declines and swift bear market rallies. And you're kind of seeing that right now, is that we've had this kind of steady decline since late last year, and we're getting a bit of a bear market rally as sentiment got really, really overly bearish over the past month or so. And these are dynamics that you need to understand as an investor. So you're not shaken out of positions, you know what kind of market we're in, and you can capitalize on the right opportunities, as well as not be taken with the risks that are out there. And there are always risks, different types, different sectors have different types of risk, from interest rate risk to credit risk to cyclical risk, commodity risk, etc. There's so much to really balance out each and every day when you're trying to make decisions, and that's what I'm here to help you do, is understand the market dynamics and put the odds in your favor. So I'm Justin Klein. I look forward to this hour with you, answering your finance and investment questions with my straight and unbiased answers. And today's investing situation is different, as we've discussed many, many times, and therefore your playbook has to adjust as well. So my goal is to help you understand this environment and succeed, and gather the tools that you're going to need to make consistently good decisions. I get calls all the time about one particular stock, and that's not our goal here. Our goal isn't just to give you particular stock ideas. Our goal here is to give you a mindset, give you the tools so that you can do this on your own, so you can make good decisions day after day. Know what a good company is, a bad company, know whether you're chasing performance or taking a tip versus making a good solid decision based on the fundamentals, on reality, on good sound logic. And I invite your phone calls and questions right now during our live stream program from 4 to 5 Pacific time. Or if you're listening after hours, which I know a lot of you are, you can call our 24-hour listener line, which is 888-99-CHART. So let's get right to our first listener question now.
Hi, my name is Lou, longtime listener. I was wondering what your thoughts are on PIMCO Dynamic Fund, PDI. I've invested a little bit into that fund, and I'm just wondering if I should continue investing or just hold it. Thanks. Bye.
All right. This is the PIMCO Dynamic Income closed-end fund. And with a lot of these bond-focused closed-end funds, they pay a high distribution rate, about 12.5%. But to get that, they have to put leverage on their positions, 46% leverage for this particular fund. And that is great when times are great in the bond market, but it cuts both ways. Leverage always cuts both ways. And that's why so far from its peak around $30 per share, it's all the way down to 21. So it's down, call it a third over the past about year. Yeah, because it peaked back in June of last year. So took a year, steady grind lower as interest rates went up, and that leverage obviously hurt. And whether you're getting 12% payout, but if you're dropping 33%, you're down 20+%. Okay, so that's not a great dynamic in a rising rate environment. Now, let's look at what they're invested in. It's quite complex. There's, once again, a lot of leverage. Let's look at the type of bonds they have. 19% government, 30% corporate, 29% securitized, 11% cash and equivalents, and about 9% in others. Now, the maturity schedule, let's take a look at that. Most of them are relatively short term, but it's really all over the board, from short term all the way to very long term. About 6.5% of my portfolio is over 30 years. So pretty spread out. Now, I don't have, let me see this. Yeah, it's not giving me any data on like the average maturity, etc. But I just don't like the leverage here. It's not I don't like to take leverage in the bond market just to get that, to chase that yield. Maybe as a very small percentage of your portfolio, that's fine. But what you can see here is that because it dropped 33%, it's going to have extensive duration risk. And that's not what I want. I don't want a ton of duration risk in my portfolio. So the fact that it looks like, 40, 50, 60, 70% of the holdings are in long-term bonds. And I don't like that. So near term, I do think it's going to get a rally because rates are coming down a bit and pulling back, but not a name that I would own long-term. That was PIMCO Dynamic Income, PDI. Now let's, we're going to go to Robert. How you doing, Robert?
Doing well today, Justin. How are you?
Doing pretty well. It looks like you want to talk about Kohls, KSS.
Yeah, I was just taking a look at that today, and I know a lot of the retail stocks have gotten hit pretty hard the last month or so, and Kohls certainly is right there with them.
Mm-hmm.
But I'm just wondering, with this now nearly 7% dividend, if you think this would be an opportune time to start a position in Kohls.
Well, once again, I try to break everybody of this. 7% dividend, should be an irrelevant fact for everybody. It should be very low on the priority list. Okay, it's all about the business and how stable is their business, how stable is their balance sheet. They have a little bit of debt, but not too much. Trading at relatively low multiple enterprise value to EBIT at 2 times. That's pretty cheap. And historically, that does trade between about 2 and the high of about 12 recently. So I do think it is on the cheap side. The issue always with Kohls is kind of longer term, is how sustainable is their business model with their kind of standalone department stores. Now they're well diversified in 49 different states, so that's a good thing. But I wouldn't focus on that yield, because the yields, they may not sustain that yield. When you look at their payout ratio, actually it's only about 22%. Yeah, so that's actually not too bad. I have no problem with it down here after this drop because it is so cheap. But remember, don't just focus on the dividend, focus on the business, which is very volatile, and certainly activity is going to cool down, and already has. Last quarter, revenue down 4%, earnings down 90% year over year, and just shows the volatility of their business. So not my favorite in the retail space, but it is cheap enough for me to take a good crack at it down at these levels. That was Kohls, KSS. Now let's pivot to, now we're heading into a break, actually. And I welcome your finance and investment questions on 888-99-CHART.
Why do listener questions make InvestTalk better?
Which of these would you recommend?
Because each caller presents fresh questions in their voice.
I was curious if you still think aluminum has a ways to go from here.
When do I know the right time to take profits?
Should I be looking for an exit? Should I be holding here?
And listeners instinctively realize that InvestTalk uniquely offers a welcome dose of investing satisfaction.
I think you have a terrific show, and I've learned a whole lot.
Hey guys, love your show. I've been listening for several years now, and I've learned a lot.
Justin Klein and Steve Peasley understand what investors need and want.
I would look at it from a tax perspective. If there's no tax implications, move on, find better ways to use that money.
I'm going with the odds. I think a half position now would at least get you in it and get you watching it so you won't lose track of it.
Don't forget to call InvestTalk. 888-99-CHART. Each day, InvestTalk listeners submit their finance and investment questions via phone or email. Would you like your question to be put near the top of the list? Just take a minute or two to leave a review and rating for InvestTalk at iTunes. And be sure to include a brief question with your iTunes review comments.
Now, my focus point today is based on this headline. As mortgage rates soared, pending home sales fell 20% in June. So we're going to look at the trends there in the various regions of the country. And in connection with that, I want to touch on the markets that are probably going to struggle the most as we go through this housing, I call it correction. It was overstimulated. There were various factors that were driving prices up, including mortgage and rent moratoriums. So new supply coming on market was held back because of that. And then you had just cheap money and people needing to move into bigger homes, out of state, etc. And that drove up the prices in many markets. So we're going to look at the trends there. And then carbon credits. This is something that has been hot lately over the past few years as a good investment, but it's starting to sell off. And I think there are some interesting reasons why, and why you may want to temper your expectation for gains in the carbon credit market if you own some of the ETFs or companies that are exposed to that. So we're going to look at that story. And then the tech workers used to be able to get whatever they wanted. Well, not as much anymore. And look at some trends in the tech worker space. Okay. Now let's take a look at the market today. We had the S&P that was up 48 points, a little over 1%. Nice follow through from yesterday's Fed announcement. Now remember, when there's big news, whether that's about the market as a whole, about a particular company, there's usually a 3-day period of the markets adjusting to this news, and then you get a snapback or some sort of settling in. And I think we're still in that phase. We had earnings from Meta, which were disappointing, but didn't really drop too much, down $8, about 4 or 5% on Meta, but didn't break the recent lows. You had Netflix after hours today that was up nicely. Apple was up slightly after hours, and we continue to roll through earnings season, which is doing okay, not great, but just okay. And the market is fine with that. Fine with earnings so far, an okay earnings season, with a Fed that looks to be acknowledging weakness in the economy and thus likely to reduce their pace of tightening. And I think that's what's really giving the market a move today or yesterday and today. And a big indication of that was the yen. Because of interest rate policy changes, that's usually what mainly drives currency markets. It's not the only thing that drives currency markets, but it's the main thing. And what's interesting about the yen is everyone knows their policy, right? They're keeping rates at 0.25%. They don't plan to raise rates. Inflation's gone up, but not to a level that is worrying Japan in any way. So their policy is very static. So when the market in the yen moves, it's not really sending a message about the yen or the Bank of Japan and what they're doing, but it is sending a message about what the Fed might do because of that particular, because the Fed's policy is more fluid than Japan. And so when the yen rallies like this, that is giving indication that the Fed is likely to pivot. You had short-term rates come down as well today after rising a bit yesterday on the Fed news. And the 10-year has pulled back 5 basis points today after a little bit of a drop yesterday, now down to 2.68%, the lowest level really since April. And then gold got a nice lift on top of that, and it is also very correlated to the yen. So if the yen gets stronger, that's going to give strength to gold. Well, this is InvestTalk. We are heading into our first hard break, and your questions drive this program. So that's why I encourage you to give us a call at 888-99-CHART.
InvestTalk is here to help. And when you download the free InvestTalk podcasts, don't forget to rate and review. The phone lines are open, 888-99-CHART.
Now, my focus point today is based on this headline. As mortgage rates soared, pending home sales fell 20% in June. And with the exception of the first 2 months of COVID, home sales were at their slowest pace since September of 2011. Yeah, 2011. Big shift in the housing market in a short period of time. And that shouldn't shock anyone with the mortgage rates averaging about 6% by the middle of June. And on a monthly basis, pending home sales fell a wider than expected 8.6%. That's worse than what most economists were expecting as a 1% drop. But year over year, sales are down 20%. So 20% year over year and 8.6% month over month. And the big question is, how long will the weakness last? And I've said this, as long as we remain above 5% on the 30-year, then we're probably going to remain in a correcting market. And we pulled back, so 6% is now more like 5.25 on the 30-year. Jumbo's more like 4.5, 4.75. I'm seeing some as low as 4.25 on the jumbo side. So this is clearly sapping demand, and especially in the South and the West, where in the South, sales declined 8.9% month over month and 12.2% year over year. In the West, 15.9% month over month and 31% year over year. The Northeast and the Midwest weren't as bad. Northeast 6.7% year over year down and 17.6% year over year, 6.7 month over month. And Midwest, that was down only 3.8% month over month and 13.4% year over year. So those are kind of the breakdowns of the North, South, East, and West. And the Midwest, that is the best performing, whereas the West is the worst performing. And builders are starting to offer more incentives to offload inventory. And I said this before, builders were making a lot of money, ton of money. Much higher margins than they were used to. Typically in the low to mid 20% range, builders were making 30% margins on their homes because of the prices. So they have a lot of room to cut prices, and they're going to be the first ones to do it because they know they need to move that inventory. Whereas most other people, they can sit on their home and wait a little while and try to get the best price. And I think that's going to be a bad decision. If you're trying to sell your home, you need to be realistic about what's happening right now in the market and be quicker to cut versus everybody else. Now, if you look at particular parts of the U.S., there are some that are going to get hit more than others. Now, number one likely is going to be Boise, Idaho. It was one of the hottest Zoom towns, they call them. Remember, everyone moving to different parts of the country, working remotely, and arbitraging that cost of living from those high cost states like here in California and elsewhere. Now, buyers are starting to balk at those record prices, and 61% of listings in the Boise metro area cut their price in June. 61%. It's the highest rate of 97 metro areas surveyed by Redfin. Now, home builders are also cutting back construction in that area, and it's not nearly as affordable as it used to be. The Boise isn't, and this is you've seen sales across the U.S. Fall for 5 straight months, and this is not a one-off event just for Boise. There are other areas like Denver, Salt Lake City, Tacoma, Washington, Phoenix, Arizona, and Austin, Texas. Those are probably the areas that have the most room to fall from the high, and just pull back. And this is what I'm speaking about. This is more of the market pulling back. Doesn't need to be a crash. It's just there were pandemic anomalies that brought prices to unrealistic levels. Just like back in 05, 06, when there were lending anomalies that brought prices to unrealistic levels, and then things reverted. There's similar dynamics in that sense, but also differences in the fact that people were being lent to were still very good credits, whereas back in 05, 06, not very good credits. Now, inventory in Ada County, which is around Boise, that's up 176% year over year. Austin, Texas, up 218% year over year. Phoenix, Arizona, up 156% year over year. So these are examples of areas that are going to have larger pullbacks, larger reversions to the mean. And that's what it is, reversions to the mean, and the multiples that the homes are trading at to incomes are going to come down, just like the multiples in stocks. Long duration assets get hurt when interest rates go up, okay? Now, long duration assets could be long bonds, right? 30-year treasury, for example, but there's also growth stocks. Those tend to be long duration assets because it's all about what's happening 5, 10, 15 years from now, like we've spoken about. That's a long duration asset. That's why they get hurt the most in rising interest rate environment. Homes are also a long duration asset. 30-year mortgages, 15-year mortgages, all of these are reliant on low interest rates. When interest rates go up, you see things like this. So those are the dynamics in play right now, and you don't need to be panicked about it, but just understand the real estate market that we're in now. Now, on the next InvestTalk, the story behind this question: how is a bear market different from an economic recession? Steve will get to that story tomorrow, but for now, I'm Justin Klein, and I'm ready to take your questions live at 888-99-CHART. This is it, the putt to win the tournament. If you sink it, the championship is yours. But on your backswing, your hat falls over your eyes. Is this how you're running your business? Poor visibility because you're still relying on spreadsheets and outdated financial software. To see the full picture, you need to upgrade to NetSuite by Oracle. NetSuite is the #1 cloud financial system that gives you the full picture of your business. With visibility and control of your financials, inventory, HR, planning, budgeting, and more. NetSuite is everything you need, all in one place. You can automate your manual processes and close your books in no time, while staying well ahead of your competition. 93% of surveyed businesses increase their visibility and control after upgrading to NetSuite. Over 31,000 businesses already use NetSuite. This summer, NetSuite has a special financing program for those ready to upgrade at netsuite.com/investtalk. Head to netsuite.com/investtalk for this special one-of-a-kind financing offer on the #1 financial system for growing businesses. netsuite.com/investtalk. netsuite.com/investtalk.
School is back and doorbusters are in session at JCPenney. Score best-in-class deals for your whole crew like $6.99 tees and $21.99 denim from Arizona Jean Company. Spice up your new space with Cook's Kitchen Essentials starting at $19.99. Hurry in store while they last, or buy online now, pick up curbside later. Shopping is back, and the savings are too. JCPenney. Doorbusters valid on select styles through 8/3. Exclusions apply. See store or jcp.com for details. Do it!
One of the most rewarding things I do each weekday is host the InvestTalk podcast. I truly enjoy helping investors, and I know that every question counts and every answer I provide will be unbiased. You, the caller, get to chart the course for each InvestTalk podcast. Call with your questions anytime, day or night, 888-99-CHART.
Hi, Steve and Justin. Thanks for all you do. Quick question. Would love your opinion on Verizon. It's down quite a bit. I did have an alert set for under $45, and recently did dip under that mark. Dividend looks very, very safe, so looking to add this to my long-term dividend portfolio, and just would love your opinion at this point. Thanks again. I'll listen on the show.
All right, looking at Verizon, and I will say it is pretty cheap down here, around $45 per share, so I liked your trigger. Now, I would say that the dividend is not very, very safe. I think that's a bit of a stretch there. And now, if you look at the payout ratio, it's about 51%, but the cash dividend payout ratio is about 105%. So in order to pay that dividend, it's going to have to take on a little debt, which is fine. But it's when you have a cash dividend payout ratio around that 100% level, that doesn't make it very, very safe. Now, their business model is pretty steady, so it is on the safer side, but I wouldn't classify it as very, very safe. It does have some risk there, and the fact that a company like T-Mobile is taking some market share. And I think that's really what's driving this down. You had AT&T with bad earnings as well, and worried about customers paying their bill. And I don't really worry about that too much. I think that's a bit overblown in the market because they're still going to have to pay it. They're still due that bill, but it just shows you their cash flow has been lower because people are slower to pay their cell phone bills. So I do like it down here. I think it's a good value. Is it the best value in the telecom space? I wouldn't say that, but it is a very solid value down here around $45 per share. So thanks for the call. Now, when people take the time to leave an InvestTalk podcast review on iTunes, we like to thank them for their courtesy by getting to their question quickly. Jay Kaz says, what do you do with your funds once you realize we are entering this particular bear market? Also, do you just strategically transfer funds from one stock to another and let the market go where it goes and make sure you have your funds in the most favorable positions based on the current circumstances? Question mark. So that's the question. I'll just address this broadly. When you realize you're in a bear market, it's usually too late to do a whole lot. You should have done it beforehand. You want to make changes to your portfolio when things are good, not as much as when things are down. That doesn't mean you shouldn't make changes. You definitely look at the economic backdrop to understand what type of risk you're taking, what sectors you have allocated to, and which ones you should be overweight. Now, if you continue to think that the bear market is going to continue, then you want to be overweight more non-cyclical type of companies. But you also have to look at the inflationary backdrop. So we still like industrials and energy because we think the inflation is going to remain relatively elevated. So it's really just about creating an asset allocation and continue to rebalance and adjust that asset allocation based on the economic backdrop. That's how you do well in all types of markets. Okay. So whether we're in a bear market, I hate the term, just like a recession. A recession or a bear market, they're all almost both overly simplified. A bear market's 20% down. A recession is 2 quarters of a row of negative GDP growth, real GDP growth. But it could be a mild recession or a mild bear market. It could be a recession that is long-lasting and very deep, like the financial crisis, or it can be a bear market that is very deep and long-lasting, like the financial crisis. Most are not like the financial crisis. Most bear markets, most recessions are not like '08. There's been 2 over the past 100 years, '08 and 1929, that were that bad. It's extremely rare to get those things. It's definitely rare to see them back to back. So this, and the reason that it's rare is because politicians, investors, companies, as well as investors, have a short memory. And they try to avoid the things that caused that bad of a situation back then. And so collectively, when every actor avoids that situation, usually you don't get that outcome, right? It's when actors within the economy, within the system, ignore the risks, right? Don't have a memory of bad decisions, bad things, really bad things happening. That's when they take the eye off the ball and they kind of brush the potential risks aside, like they did with subprime, et cetera. Remember Bernanke saying, "Oh, subprime's contained," et cetera, because they didn't have that memory. Okay, so what you need to do in a bear market is understand, look around, and say, is this like the last bear market? Is it like the last recession? Or is it more along the lines of your standard bear market or recession? The odds are very good. Once again, the last recession is not going to be like the next recession. They're very different. So you see it right now, and you need to just simply focus on the opportunities that are presented to you. The different companies, the different sectors that are attractive right now, based on longer term, when the economy does recover, which it will. It will even out. It will recover. America's not going away. Okay. So hope that helped you, give you some perspective, and don't be reactionary. Have a plan, execute it on a daily basis. Let's go to James in New York and wants to talk about PayPal.
How you doing tonight?
Doing well.
So I own PayPal, and I'm not quite ready to sell it. I think it has a ways to go. It had some really good strength yesterday, and I believe earnings are supposed to come out next week. Do you advise that I maybe hold on to it or take some profit? It's a very small position in my portfolio.
Yeah, I mean, I think I had this call yesterday on the show, and as I'm saying, yeah, I think PayPal is a reasonable value down here. Earnings are, it looks like, on August 2nd at the close, so next week, and I think it's a good value down here. Now, is it going to return to 300 like it was back in September? Probably not. But it's a reasonable value, good secular growth drivers. And so I would probably hold it through earnings. It's been very, very oversold, and it's trading at a reasonable multiple. So I would hold it through earnings. Thanks for the call.
Hey, thank you.
Now let's touch a little bit on carbon credits. And what's interesting recently is that carbon credit prices have been on the decline. They peaked in February at $13.10, and they fell to $8.17 as of what was that, in March? When was that? Just recently. And carbon credits basically are things that companies will buy to offset their emissions. And this is the global plan to try to incentivize companies to reduce their emissions by putting a price on what they are emitting. And, it's interesting that it's kind of narrow, right? Because you don't have we don't have credits for pollution of, ash and chemicals and things like that into the earth and the groundwater, et cetera. So carbon credits are very narrow. And historically, they have been pretty pretty uncorrelated with the overall equity markets, but that has started to change. This recent sell-off, more speculative carbon credits fell more than higher quality carbon credits. So they're starting to act a little bit more like equities. Rising prices have also, or rising interest rates, have also affected speculation within the market. So less capital to go and bet on higher prices. So that's increased the volatility. But I think also the trends with ESG are a big factor as well, because just look what's happening in Europe. If you cut off the investment, right, you make it more expensive to drill for oil and gas, then you're going to have these shortages. And are carbon credits going to contribute to that? Are they going to change? Are they going to continue to ramp up the cost, which makes it more and more uneconomical to drill for oil and gas without having a strong replacement? And I think that's the biggest worry here. And so if you have a lot of exposure to carbon credits, you probably should be a little bit worried, maybe reducing your exposure, because the chart, if I look at KRBN as a good example, that's the carbon ETF, the Crane Shares Global Carbon Strategy ETF, that had a big drop, went from 55, hit a low of 35 in just a span of 3 weeks in February. Now it's recovered around 50, and now it's dropped back again to around $44 per share now. So it's clearly in a downtrend. The technicals are getting worse. And so once again, the trends here are a bit worrying when it comes to carbon credits. Part of that, once again, is higher interest rates. Part of it could just be the changing attitude to how the world is trying to deal with carbon emissions, and the energy crisis we're kind of stumbling into, especially in Europe and around the world, is likely to create backlash for things like carbon credits. And so I would encourage everyone to limit their exposure to this space. All right. Thanks for the call. Now let's pivot back to the InvestTalk voice bank for this question that came in earlier at 888-99-CHART.
Hi, Steve and Justin. This is Jason from Stockton, California. And I've been investing for a time in equities and in Forex, and I've started venturing into futures. But I wanted to ask you about bonds. And I'm just wondering, why would somebody choose to invest in bonds? And I guess the second part of that question would be, how do you know whether you should hold the bond to maturity or whether you should sell the bond early? And why would somebody do one of those things? Hope to hear your answer. Thank you. Bye.
Okay. Very good question. Why would somebody invest in bonds? Simple. Steady, consistent, reliable income. You can't say that about Forex or equities or really any part of any asset class. Maybe real estate, you could say that for good high-yielding rental real estate. But with that, there's headaches that come along with that potentially, and certainly different types of risks. But with bonds, you are getting low maintenance, right? You own it, it's going to pay that dividend or that interest as long as the company or the entity is still around and not filing for bankruptcy. So we have plenty of clients. We have, I would say our total book, somewhere in the neighborhood of 20 to 25% of our book is in bonds for clients. And we like high-grade corporates typically are the best, I think, risk versus reward. But every different type has its merits, especially munis if you're in a very, very high tax bracket. But that's why people would want to invest in those individual bonds. Now, what's the difference between holding to maturity versus rolling them? We call them rolling them, where you're selling, they're maturing in the next year or so, and you want to roll them out to a longer maturity. And usually you want to do that when the yield curve is steep. For example, let's go back 2 years. Interest rates were very, very low, rock bottom. 1 year treasury rates were 0.5% or less. So if you had a bond that was maturing in less than a year, your yield to maturity was maybe 1%. So you could sell that bond, and you can go roll that out to a longer dated maturity, maybe 4, 5, 7 years and get 4, 5%. This was a couple of years ago. And so now you're locking in a higher yield. And so for the next year, you're not just earning that 1%, but you're earning that 4% or 5%, whatever that yield on that new bond is. And then that same yield, out years. So that's why a lot of people will roll their bonds over in situations like that. Now, in this market, it's not quite as good, where the short-term rates are a lot higher, 3 to 10 years. The 10 years now at 2.5 or so. So 1-year corporates are typically yielding 3-ish rate, and you can still get better yields than that going out longer, but it's not nearly as attractive. So that spread between those aren't nearly as attractive. So that's why you would roll some. In some situations, it's more attractive to roll it out. Some, it's not as attractive. When it's not as attractive, maybe you just want to hold it to maturity. You don't want to take that longer duration risk, because that's what you're doing. That's what you're doing if you are selling a short duration bond where it's maturing within the next year, and then you're buying one that's farther out, matures in 2028, 2029, etc. That's increasing your duration of your portfolio. And maybe you don't want to do that right now. Maybe you think that yields are going to continue to go up, and you want to be patient, wait for that bond to mature, and then buy something later that's going out. So those are the different reasons why you might roll versus hold to maturity. Thanks for the call. This is InvestTalk. I'm Justin Klein. We have one goal here, is to help you achieve your own version of financial freedom, and our work continues after this final break. So if you're going to call, you want to do it right now at 888-99-CHART.
You are listening to InvestTalk. Every Friday on the program and the podcast, Steve Peasley shares highlights from the newest edition of the KPP Premium Newsletter. Listen Fridays to InvestTalk. And now, Steve and Justin welcome your calls and questions. 888-99-CHART.
Hi, Steve and Justin. This is Kevin from California. I had a question regarding reverse mortgages. I'm trying to get a feeling of what you think about. The reason why I ask is because my in-laws, they did a very poor job of managing their money and into retirement, and they still have a mortgage that they're barely paying. So we've been assisting them for a while now by paying into the mortgage, and now thinking about doing a reverse mortgage on it so that there's no more payments. What I want to do is make sure I don't lose any of that money that we've already put into the house, and trying to get a better idea of what you think, because I've only heard negative about reverse mortgages at the end of the mortgage, when they pass away. What kind of debt might be involved, and is there any way to salvage the house afterwards? There is some equity in there, so again, I just don't want to lose what I've already invested into it. Hopefully you have a site that I can listen to for on the show. Thanks.
All right, great question. Now, reverse mortgages, I would say, are a last resort. You shouldn't rely on them, and the main reason is because they are very expensive. Interest rates are very high. There are high fees to set them up, etc. But they can be useful in the right situation. Now, the general rule of thumb is you have to have at least 50% equity in the home in order for you to do a reverse mortgage. And they vary in their terms, and sometimes you can get a consistent cash flow from the reverse mortgage to live off of, etc. Now, there are rules around what happens if you go into a nursing home. You have to sell the home, and typically, because of the high interest rate, the high fees, the home is not going to go to your heirs, unfortunately, unless they have money to pay off the high mortgage. And if that's the case, then they might as well have just given you money to live off of. So you kind of have to be resigned to the fact that home is probably not going to the next of kin. But if you don't have another way to get some income, and it's your largest asset, and you have substantial equity in it, you don't want to move out, because that's then a reverse mortgage is not a bad idea. You could do a home equity line of credit, but that's not guaranteed. They can pull the equity line of credit once the reverse mortgage is in place. Then it's in place. So that's the nice thing about it. So once again, last resort, you need about 50% equity in the home, and it is very expensive. So it shouldn't be your fallback. It should be a fallback option, not a main option. Now, lastly, let's talk about the dollar. And the dollar index it's up about 8.7% this year through the month of June, and it notched its best first half since 2010. And it's now at parity with the euro for the first time since 2002. And a lot of this has to do with higher interest rates. Now, there are other countries that are raising interest rates, including Mexico, Peru, Poland, Czech Republic, Chile, and Brazil. Brazil has gone from 0% at the beginning of the year to over 10%, 13.25%, as of June. And so against those currencies, the dollar's not nearly as strong, but against the euro, who's been, the ECB has been slow to raise rates, against the yen, where the Bank of Japan has been unwilling to raise rates at all, those are the biggest weights in the dollar index, and that's why you've seen this major increase. But it does have an impact on other countries as well. You see Sri Lanka filing for bankruptcy and defaulting lately, and that was back in May. They have a lot of debt and crazy inflation because of ESG mandates that they imposed on themselves, and clearly that hasn't gone very well because they are a net importer. They're an island basically, and importing a lot of basic goods, fuel, medicine, etc. And if you have countries that are big importers, net importers of goods, and they'll have a lot of dollar-denominated debt, like Argentina, Ukraine, Colombia, they're going to be more in trouble versus other countries that have net exports, meaning they're probably getting paid in dollars. They're getting more dollars coming into their economy than they're sending out. Those tend to do much better. But a strong dollar historically is bad for these emerging markets. So just want to give you a heads up there, what's happening and what impact the strong dollar is having around the world. I'm Justin Klein. This completes another InvestTalk program. Steve Peasley and I thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play, and be sure to rate and review. Independent thinking, shared success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein, Pavlis, and Peasley Financial, a registered investment advisor firm which retains all rights. For more information regarding KPP's investment advisors, call 1-800-557-5461. Steve Peasley is president, and Justin Klein is chief executive officer of Klein, Pavlis, and Peasley Financial. Thank you for listening, and your comments and questions are welcome on our 24-hour listener line at 888-99-CHART.